All right, let's get some audience questions. Greg, Robin, please.
You guys, as I kind of read the tea leaves between you, you talk about kind of the cultural differences between the companies. I think that's kind of your pitch to the crowd at large. Going down the road, what would be your pitch vis-a-vis these guys on why a culture might fit your company? What is it that you're looking for in culture?
We're looking for hackers. We're looking for men and women who want to drink Red Bull and Mountain Dew and stay up all night and turn an idea into an ugly-looking prototype that they can maybe buy some Google search traffic on and test and see what people, think of it. We're looking for people who are impatient, who like to write code, who want to crank stuff out, and think social is going to change the world. So I think hackers, welcome.
I think it's a great question. Ours, I think, is a little more broader in that I think there's the company has a culture, and for many years, has had sort of two sides of the business in regards to the hardcore technology, and frankly, we've even got the labs and the scientists and all that. And so, at its roots, we absolutely want sort of a core of that, the same thing that Mike just talked about in regards to just that those rock star talents that are just incredibly passionate about what they're doing on the technology side. But the other side of it is, we have this, sort of online media side of the business, and frankly, a lot of that is, the creative business leaders and whatnot too. And so we look for both of those things, and I think in terms of the cultural fit, I think it was one of the chief justices at 30, 40 years ago that was commenting on, I think, a case on pornography that sort of said, I know it when I see it. And I think on cultural fit, that's ultimately a lot of what it is again, you work together on these deals, you kind of know when it's a fit and you know when it's a stretch, and part of it just has to do with, I think Yahoo has, a lot of, creative, smart people who don't take themselves too seriously and like to be nice to each other, and a very collaborative culture and stuff. So, hardcore, super competitive. I have a competitive sports background, and, am very competitive and like to win, and I think Yahoo's like to win, but I also think Yahoo's, want to sort of like the people they're on the field with, and that matters a lot.
I'm not on the corp dev team, so I don't know what our corp dev team looks for in terms of culture fit. So.
Yeah, I think we've become a little bit more or less homogenous than we used to be. So, like you, we have so many different teams doing different things, and so within Google there are nuances in terms of the culture. So I can't tell a startup here, for Google as a whole, what kind of culture, but I think, you could probably guess what they are. Smart, passionate. If I was advising a startup here, I'd say focus on your business, hire the best people, hire people who know how to code, know how to work together as a team, and know how to adapt, because it's moving so fast. And even if you come to Google, things are going to change and move fast, and to be able to adapt and move in new directions I think is an important skill to have.
Kevin.
Is your guys' approach for acquiring startups different from international startups, let's say startup out of France or Russia?
And the question, if everyone can hear it, is the approach of acquiring an international startup different than a domestic company?
So I guess, the first question is, what's your definition of international startup? So Dapper was founded in Israel, has a core engineering site there, also has an office, right down the block from here, and is ultimately an American company at this point, and most of their business was there. And so, we ultimately viewed that as essentially a global product acquisition that was run out of here. A company whose sort of go-to-market business is more in the international market, that would be handled by one of our colleagues overseas. And I'd say the main difference on those is that the hit rate is typically lower and the cycle is a little bit longer, just because, frankly, the markets themselves, France probably is not a great example, but certainly, over in Indonesia and the Far East, the markets are more immature and on some levels, and also just things tend to take longer. So that would probably be the two things. I would say that conversations take longer, and the actual sort of close ratio from starting of conversations might be lower.
We tend to look for the same things that we would here. We would structure our diligence pretty much the same and try to find out the same things with respect to fit and all that. But we have to make modifications. For example, a deal I did in Sweden, it was amazing to me that at the 11th hour, what became the critical issue is how much vacation we give these people, because they're in northern Sweden next to the Arctic, and sunlight is very valuable, and for them to get that time off during summer was absolutely critical. So that's something you don't think about, or labor laws in France.
Interesting.
So you have to modify it a little bit.
So would it help a startup if, let's say, the core team was, let's say, in whatever country, they get that biz dev team, so then the presence here will actually help the process, according to you, correct?
I mean, again, you've heard a theme throughout is that no one deal is alike, and I think, again, the real answer is what's right for your business. If it's right for your business, it's going to create value in the market, and it's going to get people like us interested. So,
Richie.
I have a sort of the opposite question. How often do you guys shed assets? What's the process of that?
you haven't really gotten to that stage yet, have you?
Not often. Not often, yeah.
We continually talk about it and think about it. I mean, I think it's one of those ones where when you've grown, as we have over 15 years with the internet, you've constantly trying new things and going slightly different directions. And so, we're sort of trying to be very careful and thinking about, as almost an annual basis, making sure we're thoughtful about that. And in regards to sort of how we go about it, we typically first assess whether we think it actually, is it something that really, is fine to just maintain, and it's just not the core focus going forward, and it's, it's serving a community of users that we want to allow to continue, but we, don't necessarily need to invest in the future, or is it a business that, it runs the risk of becoming what we call a vampire site that's just sort of out there and it's not really there, and it should either be shut down, or if there is a better home for it, you just sort of figure out, can you extricate it from the technology stack and actually have something that is saleable. And sometimes you do, and sometimes you don't. If there is something that's saleable, we try to sort of get it together, get a very clear idea of what's there and what would work for us, and then talk to the appropriate people. One of the first things I spent time on when I got to Yahoo 18 months ago was selling Zimbra. And we ultimately found a home for that we felt fantastic about. I mean, it was a good outcome for Yahoo in terms of moving a business on that wasn't a fit anymore. We kept IP rights so that we could continue to use the technology as we needed to within Yahoo Mail. And then frankly, it was an awesome fit for the employees being a part of VMware. That's a business that is much more strategically aligned with them. They have a huge enterprise sales force that was able to give them leverage in terms of going after enterprise customers. And so, it's one of those deals where it's not exactly your question, but from a corp dev perspective, they're probably 3 to 10x the work of a buy side deal. But in some ways, they're the most gratifying because you get to know the management team. You feel responsible for their futures. You get to act, like a general manager of that overall business as you sort of partner with them and move it on. And I think over my career, I've probably done 10 to 12 divestitures, and every one of them, there's close relationships, and I'd say in 3 or 4 of them, there's sort of lifelong friends that are made of. You go through the wars, and they're hard to get done, but when you get them done, you feel great that you essentially took something that could have, gone in a bad direction and been nothing, and actually, helped people who had put a bunch of their lives into something get a platform that was going to allow them to go do something nice with it. So.
On our side, we're currently considering spinning off Twitter so we can focus on podcasting. So that's our big future plan. You heard it here first. So.
Nice. Who else?
We'd be interested.
Gleb. question is, who has to sign off on a deal, essentially? Just repeat it. Yeah.
Once we have enough information that we've kind of assessed that fit and we want to go forward, we move pretty fast. I think like most companies, there's an executive committee that needs to sign off, obviously corporate development, but we move pretty fast. That part's not a bottleneck. It depends, but typically that's not, at least in our case, the case. Unless there's something that we need to find out in diligence.
Yeah, I mean,
That
I think
you're
where
not
where
sharing
you may
with
be
us.
going, like if there's a deal of a certain size, as you know, as a public company, there's authority matrices and whatnot, and some deals have to go and officially be approved by the board. But frankly, it's our job to manage the process to whatever timeline of the business constraints that we have to get a deal done. And as Amin said, that's not something that slows down. I mean, when you put a term sheet out, there's essentially a business sign-off that, as you said, there's some sort of executive committee. There's usually a business leader that we've partnered with to sort of make sure we understand what it is we're doing, and we go through that. And it's pretty transparent, and we try to make sure that we manage the process in a way that we don't get surprised and the seller doesn't get surprised either.
Think of it as an engagement ring. I mean, it's somewhat facetious, but in all seriousness, I mean, we're pretty serious at that point, and we assume we're going to make wedding plans together, but if we can't agree on some of those plans, it could break off, but that doesn't usually happen.
Ben, what do you got?
So is there such thing as something too small to be worth your while? And some of the smaller acquisitions that some of you have made have probably turned out to be the most valuable ones sometimes. Can you comment on
Absolutely.
that, like the time you devote to small things and what impact it might have on organizations?
I mean, if you ask me, the ones that pop into my mind are relatively small deals that we've done that had huge impact. Examples are Keyhole with satellite imagery that became Google Earth, and along with the Maps guys, Lars, and you know Lars? But those were fantastic and very impactful and relatively small. So I don't think size is an issue. Urchin is another one. Android is another one.
So there's nothing too small, like something like $5 million type acquisition, not even worth your time.
No.
We've got one more question. Sure we do. One more. Cassie's giving me the evil eye. All right, we have two hands up. We can talk fast. Brian.
Regarding offers, how do you decide on the cash versus equity split? What are the considerations?
Cash equity split, and maybe if there's an earn-out discussion too. I know that's kind of a bigger question, but
I mean, part of the decision for us is the cost of each from our side and what you're looking for. Obviously, we're a cash-rich company, so cash is relatively cheap for us versus diluting our stock more. I think for Facebook, it would be the opposite. Maybe not.
We just do what the entrepreneur wants mostly. I mean, it's sort of true, actually. I mean, if we're willing to pay $100 to buy a company, obviously I'm using silly numbers, then that's what we're willing to pay. And so if someone wants cash because they need to buy a house or pay XYZ loan, like that's fine, that's cool. We still want people to vest and we want them to be there for time, but we don't really care.
One acquisition structure that some companies have started using, which is one of the things Naval mentioned about splitting the founder and the investor incentives, is to pay the investors in cash with some capped return and then give stock to the founders and employees. So sometimes that happens as well.
Or it could be cash vesting like stock over time.
interesting. One more, last one.
Question on what percentage of the teams and products you're acquiring you see the teams and the companies coming in and actually working on something similar or actually integrating that product into the core business versus the ones that you entirely shut down or you shift off? And when in the process do you tell the team that? Because I think in a lot of cases that can be very important, especially if you're there for several years working on it.
For us, again, as we talked about earlier, the bias is more towards tech and talent, and more than likely, we want to make use of the technology and the product in some form or fashion. And I think if there was plans to go other, the CEO would absolutely know it. I mean, that would be part of our dialogue, and you know, again, it's just you have to be transparent on those things because, again, as you said, they matter.
All right, I think that's it. Can we have a big round of applause for the panelists and the sponsors, TriNet, Hood and Strong, Greenberg, Troward. These guys are awesome. This was fun. Thanks all for coming, and I think we're going to do another one of these in the spring, so stay tuned.